In a dramatic development that could reshape global finances, U.S. officials have been making private appeals to China, urging restraint in an escalating economic confrontation. The unfolding situation could significantly impact every American's finances. China holds $760 billion in U.S. Treasury bonds, second only to Japan's holdings. Washington's concern centers on China potentially executing what analysts call the nuclear option, a massive sell-off of these bonds in response to Trump's tariff policies. This financial leverage poses a serious threat to the American economy. If Beijing decides to dump these bonds, the consequences would be severe, potentially triggering other nations to follow suit and leaving the U.S. facing massive debt obligations. The tension between President Trump and Chinese leadership has reached a critical point, with both sides engaged in a dangerous economic standoff. The tariff disputes have created an environment where extreme measures might be considered. President Xi Jinping's calm demeanor throughout this crisis, despite aggressive U.S. policies and deteriorating relations, has raised concerns. While some dismiss this as political posturing, others suggest Xi's confidence stems from knowing he holds a powerful economic weapon. China's strategic accumulation of these bonds represents years of calculated planning. As tensions escalate, this financial leverage could prove to be America's economic weakness. While using this nuclear option would harm China's interests too, rational economic considerations don't always prevail in international relations. The coming weeks could determine whether this economic weapon remains unused or triggers an unprecedented financial crisis. Stay tuned as we monitor this developing situation that could reshape the global economic order. In a critical development reshaping global economic dynamics, China's position as a major holder of U.S. Treasury bonds has become increasingly significant amid rising tensions between the world's two largest economies. The story begins in the late 1990s, when China emerged as the world's factory, flooding American markets with everything from toys to electronics. As American consumers sent billions of dollars to China, Beijing made a calculated move, investing it back into U.S. Treasury bonds. This strategy served multiple purposes. It helped keep the yuan's value low, making Chinese exports more competitive. It provided China with a secure way to store foreign currency reserves. Most importantly, it created economic interdependence between the two nations, reducing the risk of conflict. By 2011, China had become one of America's largest creditors, with investments exceeding $1.3 trillion in U.S. debt. While this amount has decreased, China remains second only to Japan in Treasury holdings, and their geopolitical leverage has increased. The timing is critical. The U.S. government's budget deficit has surged beyond $2 trillion in 2024, driven by military expenditures, social programs, and interest payments on existing debt. To cover this deficit, the U.S. Treasury issues billions in new bonds weekly, relying on foreign governments and global investors. This creates a precarious situation. While some suggest China might use its Treasury holdings as leverage against U.S. tariffs through a strategic sell-off, such a move could trigger a global financial crisis. As economic challenges converge, the interdependence becomes both a safeguard and a potential weapon. The Treasury market stability hangs in balance, with investors watching how this economic chess game unfolds. The question remains: will China's financial leverage force a recalibration of U.S. economic policies, or will both nations maintain their uneasy alliance? In a dramatic shift that could reshape the global financial landscape, tensions between the United States and China are reaching a critical point as we enter a turbulent election year. With Donald Trump's potential return triggering new tariffs, Beijing faces pressure on multiple fronts, from Taiwan issues to technology sanctions and strengthening U.S. alliances in Asia. While China has shown restraint in financial responses, 2025 could mark a turning point. With technological sovereignty and economic independence at stake, Beijing might leverage its powerful financial weapon, U.S. Treasury bonds. First, flooding the market with Treasury bonds would cause prices to plummet and yields to spike. This would increase borrowing costs for the U.S. government, exacerbating the deficit. As interest payments balloon, Washington would need to borrow more to service existing debt, potentially triggering a debt spiral. Second, the ripple effects would extend beyond government debt. Higher yields would impact the entire economy, driving up rates on mortgages, auto loans, student loans, and credit cards. Millions of Americans would feel the impact on their monthly payments. Third, confidence in the dollar's global dominance could be undermined. The dollar's international trading supremacy rests on U.S. economic strength and trust. If China, the second-largest holder of U.S. debt, signals a loss of confidence in U.S. creditworthiness, other nations might follow suit. This could trigger a snowball effect, with major holders like Japan, the United Kingdom, and Saudi Arabia potentially pulling investments. Such a scenario would challenge U.S. Treasury bonds' status as the world's safest asset, fundamentally altering the global financial system. In a significant development reshaping global financial dynamics, China continues reducing U.S. Treasury holdings, marking a potential turning point in international economic relations. Recent data shows China has cut U.S. bond investments by nearly $60 billion in 2024, raising concerns about dollar-based financial system stability. These Treasury bonds, serving as collateral for transactions worth trillions, are crucial to global economic stability. While skeptics argue China wouldn't risk a massive sell-off due to potential self-inflicted damage, including yuan appreciation and export losses, mounting political pressures might force Beijing's hand. China's President Xi Jinping faces pressure as the U.S. implements technology restrictions and raises tariffs while strengthening military alliances across Asia. This tension has evolved beyond trade disputes into a broader strategic conflict over global influence. China's approach to reducing dollar dependency is methodical. Rather than executing a dramatic sell-off, Beijing pursues gradual divestment while diversifying reserves. The country has increased gold purchases and expanded currency swap agreements with Russia, Brazil, and Saudi Arabia. China is actively promoting its digital yuan for international trade. This move, combined with reduced treasury holdings, suggests a plan to minimize dollar reliance. Market experts suggest China doesn't need to sell all bonds to create market turbulence. Even reduced purchases could send powerful signals to global markets. The question isn't if China will continue this strategy, but how fast they'll push it. This shifting landscape reflects a transformation in global economic power dynamics. As China executes its long-term strategy, the implications for American financial dominance remain a critical concern. The coming months will determine whether this gradual decoupling accelerates or if both nations can find economic coexistence. The financial world watches this development closely, understanding that the ramifications could reshape the global economic order for decades. China has dramatically reduced its U.S. Treasury bond holdings from $818 billion to $760 billion, marking a significant shift in international finance. The steepest decline occurred in February, with China selling $23 billion in bonds in 1 month. This marks the 9th consecutive month of Chinese divestment from U.S. securities, with November seeing a $10 billion reduction. Experts view this as Beijing's strategy to diversify reserves and reduce U.S. debt dependency, while strengthening its position through alternative assets, particularly gold. The situation intensified after recent U.S. actions. In April 2025, the U.S. implemented an additional 34% tariff on Chinese imports, adding to the existing 20% rate. The total 54% tariff effectively increases Chinese goods cost by more than half, affecting electronics, clothing, machinery, and household items. American families, already facing inflation, now confront higher prices. Central banks worldwide are following China's lead, reducing dollar reserves to below 59%, the lowest in 14 years. Many nations are turning to gold, euros, and the Chinese yuan as alternatives. Market observers note this isn't a temporary adjustment, but potentially a pivotal moment in global finance. The gradual withdrawal of Chinese investment from the U.S. bond market signals a broader shift away from dollar dominance, a trend other nations are watching closely. This financial tension stems from evolving U.S. international relations under the current administration. If Beijing takes more aggressive steps in reducing U.S. debt holdings, it could trigger a mass exodus from the dollar-based system, fundamentally altering global finance. Here's a 1875-character news piece based on the provided content. In a dramatic escalation of the U.S. China trade war, Beijing has implemented staggering tariffs of up to 125% on American goods, while the U.S. has countered with even steeper 145% tariffs on Chinese products. This economic confrontation has created a ripple effect that's reshaping global commerce as we know it. Let me break down what this means for everyday Americans. A product that previously cost $100 now requires approximately $250 due to these tariff increases alone. This shocking development triggered immediate panic in financial markets, with the Dow Jones Industrial Average plummeting over 1,200 points in a single trading session. The tech-heavy Nasdaq, particularly vulnerable to Chinese supply chain disruptions, recorded its worst performance since the COVID-19 pandemic began. Meanwhile, a curious phrase has been appearing with increasing frequency in Chinese state media: Liberation Day. While never explicitly defined, the message is crystal clear. China is orchestrating a calculated movement toward economic independence from the United States. This strategic shift isn't just talk. Beijing is actively expanding trade relationships with Russia, Saudi Arabia, Iran, and Brazil, increasingly conducting transactions in digital yuan rather than U.S. dollars. The People's Bank of China has already secured agreements with the Russian and Saudi Arabian central banks for oil and commodity trades using digital yuan, a direct challenge to the dollar's global dominance. As investors scramble for safety, we're seeing a massive flight to traditional safe havens like gold and U.S. Treasury bonds. However, this traditional refuge might not provide the security it once did, given China's significant holdings of U.S. debt and their potential willingness to use it as leverage in this escalating economic conflict. The implications of this trade war extend far beyond simple import prices. We're witnessing what could be the early stages of a fundamental restructuring of global economic power, with China actively working to create an alternative to the U.S.-dominated financial system. Breaking news: global economic shift as China accelerates tech independence. In a dramatic move reshaping the global economic landscape, China is rapidly executing its plan to break free from U.S. technological dependence. Sources reveal that Beijing has launched an aggressive strategy to develop domestic alternatives in crucial sectors, including microchips, aviation, and banking infrastructure. The Chinese government has banned several American tech products from its government institutions, but this is just the tip of the iceberg. What's particularly alarming for U.S. interests is the unprecedented speed of these changes, coupled with China's discussions with BRICS partners about creating a new international currency. Financial experts are concerned about this potential new BRICS currency, which could be backed by gold or natural resources. This isn't just about creating an alternative currency, says economic analyst James Morrison. It's about fundamentally challenging the dollar's global dominance. The most worrying scenario for U.S. officials involves China executing a triple threat: simultaneously selling U.S. Treasury bonds, abandoning the dollar, and pushing American companies out of its market. Such actions would constitute what many call an economic nuclear option. Currently, the U.S. dollar accounts for 88% of international transactions. A massive sell-off of U.S. bonds by China could trigger a decline in the dollar's value, making borrowing more expensive for U.S. businesses and consumers. This would impact global markets, particularly affecting developing nations with dollar-denominated loans. The IMF and World Bank might be powerless to prevent the economic fallout if such a scenario unfolds. What began as a trade dispute could evolve into a complete restructuring of the global economic order. Market analysts suggest this represents one of the most significant challenges to the post-World War II financial system. This story continues to develop, with implications far beyond U.S.-China relations, potentially affecting every aspect of the global economy. Breaking news: global financial system faces unprecedented challenges as dollar dominance comes under scrutiny. In a concerning development for international markets, experts are warning about potential instability in the global financial system as questions arise about the dollar's continued dominance. Our financial analysts have uncovered troubling patterns that could affect everyday Americans and international trading partners alike. Let's break down what this means. Nations attempting to construct vital infrastructure, roads, power plants, schools, and hospitals, could find themselves in dire straits if the dollar becomes unstable or interest rates spike unexpectedly. The oil market, which has traditionally used dollars for pricing, could descend into chaos. When you fill up your tank, that price is tied to dollar-denominated oil trades. If the dollar starts to fluctuate wildly, oil prices could become unpredictable, leading to increased energy costs and higher prices for virtually everything else. We're witnessing the end of an era, says economic analyst James Morrison. The question isn't when changes will happen, they're already occurring. The real question is whether the world can survive without the dollar at the center of the financial system. This situation is particularly concerning given current global tensions, especially considering recent developments in the northern Black Sea region and China's growing influence in international markets. The world is transforming rapidly, and these changes could affect everything from retirement savings to weekly groceries. Some experts suggest we're entering a new financial age, where the traditional dollar-based system might give way to something entirely different. To stay informed about these developments and their impact on your financial future, follow our ongoing coverage. We'll continue to monitor these changes in the global financial landscape and bring you analysis of how these shifts could affect your daily life. Remember, understanding these changes isn't just about following the news, it's about preparing for a potentially different financial future.